Hello and welcome to Stocks Toolbox. It's Michael. In this video, we're going to explore how to know if a strategy has a sample size large enough to be deemed statistically significant. Let's get to it. So how do you know when a backtest is statistically significant? Well, it's all fairly relative to how often the events of the screen occur in general and the length of the stock's trading history and the hold period associated with the screen. So that's a lot of conditions and criteria, but I'll give you my rule of thumb. If a stock has a couple of years or more of trade history, I'd like to see something close to 30 trades in the backtest as my lower end standard for what's meaningful. I want to use the term statistically significant here, but that implies that there's more hard and fast rules and attention paid to the scientific method. And as rigorous and methodical as we are in our model development, drawing inferences from the data is admittedly a learned craft that you hone over time and with experience. But a backtest has to be pretty compelling, have some pretty compelling other characteristics for me to consider it if it has fewer than 30 trades. What characteristics? I'd probably look at the win rate and the average profit and loss and how much exposure I may want to the stock's sector, or if I specifically wanted a directionally long or short trade. Sure, this is a bit of additional work, but I've developed a shorthand in interpreting this data by looking at the shape and slope of the profit and loss chart in the backtests. What is it I'm looking for in the P&L chart? I want the slope of the chart from the bottom left to the top right to be upward and sustainable. Yes, I'd like it to be leaning more towards steep than flat, but I don't want it to be too steep, as that's probably representing an outlier group of trades. And I want to see drawdowns. If I don't see drawdowns, now not huge ones, but I want to see some. If I don't see the drawdowns, I'm going to suspect the quality of the data or the backtest. There's a perfect image depicting what I don't want to see in the profit and loss chart. A rooster's comb, top of the chicken's head. I don't want to see big steep peaks and troughs. I do want to see some smallish ascending and descending peaks and troughs as a confirmation that there's a little hair on the backtest. A little hair on it means the backtest isn't just a small sample of winning trades. If there's 30 or more trades and a 90% or higher win rate, I know there's a flaw in the data somewhere because there's zero optimization in our backtesting, which means they're robust, and it also means that 90% win rates are very rare. I view it to be a near linear relationship between the number of trades and my confidence level in the inferences that I draw from my core metrics. The more trades, the higher my confidence in the backtest stats. It doesn't mean there's an increased probability the trade is going to work out in my favor, but the higher the number of trades, the more confidence I have in the decisions I'm making off the inferences of the data. I like to look at all the stats we have available in the platform, but if I were pressed to look at just one, it would probably be the CALMAR ratio, which is the CAR/MDD. There's still more you need to uncover about the strategy and how it's performed, but this one number communicates on both risk and reward. There's no question of what my second prioritized metric is. I have to look at the number of trades. In many cases, this should be a top-down filter, and it's easy to do this inside of Stocks Toolbox by placing a weight in the trade count weight box in the robustness factors. And remember, you've got robustness to lean on. Robustness ranks the prospective trades in the opportunities table based on what you expressed was important in the robustness factors. So for me, I'm always going to start with values in the CAR/MDD or CALMAR ratio and the trade count fields. This puts my best prospects in the top rows of the opportunities table. From here, I'll add the number of trades column, which carries me to my next step of evaluating the profit and loss chart in the backtest summary report. If I haven't found something compelling, or if I feel there's too many prospects to consider, I'll go back and adjust my search. I always recommend using a volume filter and adding a value below 20 on the max system percent drawdown or max sys percent DD, as this will limit the results to the strategy symbol combinations with drawdowns no larger than 20%. But again, the number of trades a strategy has should be a top consideration for you. I'm not saying the setups triggering today with the most trades in their backtest are what you should trade. You've always got to make your own decisions, but what I'm recommending is that you should discount any strategy you're considering if the number of trades from the backtest doesn't meet your hurdle for statistical significance. So in this segment, we've discussed some ways you can start to calibrate the minimum number of trades required in a backtest to make it worth your consideration. And we also touched on how the robustness score in Stocks Toolbox makes this a much easier task for you. If this content was useful to you, consider sharing it with a friend or a family member and subscribe to our channel. Thanks for watching, and remember to stack edges in your favor.